Hello everyone, we are Group 4. In this presentation, we will examine a real-life example of big bath accounting related to declining trends of streaming channel, explore the benefits of management discretion regarding assets impairment, and assess the potential accounting impact of Apple TV Plus's acquisition of Warner Bros. Discovery Channel, both at the time of acquisition and assumption of declining viewership for the next 5 years. My name is Julia, and I will analyze the strategic use of big bet accounting method by Paramount Global. Paramount Global, as one of the largest media and entertainment conglomerates in the United States, owns Paramount Plus and other media subsidiaries. In recent years, the streaming landscape has become more competitive, and customer preferences has shifted gradually toward the bite-sized video platforms such as TikTok and YouTube. As a result, Paramount has faced downward trends in the overall revenue since 2022 and reduced market expansion across its traditional streaming businesses. In response to these challenges, in the first quarter of 2023, Paramount Global announced a 1.7 billion US dollar in impairment charges related to the integration of Showtime into Paramount Plus. This major decision resulted in a net loss of 299 million US dollar for the quarter. These financial obstacles coincided with the weakening of advertising market and the slowdown of subscriber growth, exacerbating the company's revenue pressure and damages. By taking the big bath accounting method, Paramount concentrated all losses within one financial period. Since poorly performing assets usually generate continuous amortization and depreciation expenses. Through one-time impairment, although the huge losses reduced the quarter's revenue, the resistance of poorly performing assets disappeared at the same time. The impairment of Showtime no longer contributes to the future amortization and depreciation expenses, so the company's future margins and profitability will increase accordingly, even if the underlying business performance remains roughly unchanged. In addition, Paramount can claim that the company's actions are a necessary response to the market changes, as the customer preferences shifted toward to the short-form video platforms. This narrative portrays the damages largely as a proactive adjustment to the streaming trends, minimizing reputational damages while maintaining an investor confidence by blaming the company's poor profitability on uncontrollable micro factors rather than internal strategy failure.
I'm Cecilia. Granting managers the flexibility to charge impairments on assets has several advantages, especially under fast evolving industries like streaming and digital media, where assets values can fluctuate rapidly due to the changes in customer behavior. To start with, this flexibility enables the timely recognition of impairments in response to any changes in economic environment. According to Ryan, timely impairment improves the relevance of financial reports by ensuring that assets values are reflecting their current recoverable amounts rather than the outdated values. Moreover, managers have access to internal information that external auditors may lack. This allows them to make more informed judgment when assessing an asset's future performance. As indicated by Landry, managerial insights are often valuable, crucial, and also critical for business success, as they tend to be more strategic, making reported figures more accurate and meaningful for potential investors. Furthermore, the ability to recognize impairments promptly helps prevent the overstatement of assets values. By acknowledging impairments in a timely manner, companies avoid presenting an inflated asset values, which could mislead investors and also stakeholders regarding the company's financial health. In other words, this practice can reduce future volatility in earnings and also gain investor trust. To a certain extent, there are concerns regarding the big bath accounting, where first a firm take one-time impairments to hide poor performance. Research by Milkars, Osuchak, and also Shalenko suggested that when applied responsibly, impairment flexibility can somehow improve the transparency and also the accuracy of earnings quality. To put it another way, managerial discretion, when being applied within an ethical framework, plays a valuable role in ensuring that asset impairments are timely, realistic, and also decision useful.
This is Runa speaking. I'll be talking about accounting implications if, in case of Apple, the acquisition of WBD did happen. The most suitable method is for Apple to acquire 100% of WBD shares, thereby obtaining control over WBD and all its subsidiaries CNN, Discovery, HBO. This is a business combination through share acquisition under AASB 3. On the date of acquisition, Apple TV may transfer using cash or Apple shares measured at fair value at acquisition date. This will result in decreasing cash asset and increasing Apple share capital equity, and the contingent consideration measured at fair value will be recorded as a financial liability or equity depending on terms. WBD's reported shareholders' equity of 34,829 million at 31st December 2024 is only the book value of net assets. For the acquisition analysis, Apple must measure the fair value of each identifiable asset and liability at acquisition date, including previously unrecognized intangibles like trademarks, IP, and content libraries, recognized as separate identifiable intangible assets. Adjustments to the recorded assets or liabilities increase or decrease from book values to fair values, recognize contingent liabilities at fair value, and recording the after-tax effect of adjustments in the RSC.
This is Zhen Yu speaking. Since the actual acquisition has never occurred yet, we make assumptions when considering the accounting implications. Here, Apple acquires 100% of the shares, so there is no NCI. Given the fact that WBD is very much on the market, the FA of assets like the intangible assets, content library, trademarks, and so on are likely higher than the carrying amount of assets. This uplift in FV indicates a tax effect of increase in deferred taxable liability. Any contingent liabilities will be recognized at FV even if the outflow of resources is not probable. These liabilities reduce the FVINA if recognizing the contingent liability creates a deductible temporary difference, meaning it's tax deductible in the future. DTA will be debited. Any after-tax effect of the revaluation of net assets to their fair value will be recorded in the RSC. This temporary account is disclosed in the pre-elimination entries. Goodwill or gain on bargain purchase is determined by using the formula consideration transferred minus FEINA and is disclosed in the pre-elimination entry. Pre-elimination entries are used to eliminate double entry and recognize goodwill to combine the entries as if it was one company. As a result, Apple needed to eliminate the investment account against WBD's share capital, pre-acquisition retained earnings, and reserves, recognize any goodwill or gain on bargain purchase, and disclose the RSC.
Hi, I'm Yihan. I will answer the question 4. If the trend of declining viewership of streaming channels continues over the next 5 years, Apple Inc., after acquiring WBD in 2025, would likely face significant accounting implications. Specifically, Apple will need to conduct impairment tests on the acquired assets, with particular focus on intangible assets, such as goodwill, brands, and trademarks. According to accounting standards, when there are indicators of impairment, such as a continuous decline in revenue and user-base loss, companies must conduct asset impairment tests to assess the recoverable amount of those assets. If the book value of an asset is higher than the recoverable amount, an impairment loss must be recognized. The junior entries are as follows: debit impairment loss. This part will be recorded in the income statement, reducing current profit, and credit accumulated impairment loss. This part will be offset against the book value of asset on the balance sheet. This accounting treatment will impact both the income statement and the balance sheet. The impairment charge reduces reported profit in the income statement, while on the balance sheet, the value of intangible assets and total assets decrease correspondingly. In this case, if the WBD continues to underperform post-acquisition, the significant goodwill and brand value recognized during the acquisition may become unsupported and require impairment. In summary, if the streaming industry continues to decline, Apple will face the risk of impairing multiple intangible assets.
This would negatively affect the company's financial performance by reducing profit and asset value.